everyone. My name is Julie Hyman. I'm the host of Market Domination on Yahoo Finance. I've been oh, maybe I'm not. I can hear myself. Okay, that's weird. Is that better? Just bring up the mic a little bit. How's that? Maybe. Okay. I am the host of Market Domination on Yahoo Finance, and I've been a financial journalist for a while, formerly at Bloomberg Television. So I guess I'm up here representing the traditional media, and then there are these fine folks next to me who are representing in the influencer class, if you will. And so that's what we're here to talk about, that sort of new media format, if you will, and ways to educate people about markets and the economy and business. So with me here to my left is Jack Farley. He started Forward Guidance, the podcast, which had 30 million downloads, and then 2 weeks ago, he started something different, the Monetary Matters podcast, and he started a new media company, which includes both that podcast and a hedge fund consulting company called HedgeHype Solutions. And then Kyla Scanlon is with us as well. She's a financial content creator and educator and a Bloomberg Opinion contributor, as well as author of In This Economy, How Money and Markets Really Work. And you can see her work on social media and on various media outlets as well. So I'm excited to talk to both of you. And where I want to start is kind of how you got started, how you both embarked on this journey. I mean, my journey was a traditional one, ended up working for a newspaper and then Bloomberg and kind of followed that financial media path. You guys have done something very different. So Jack, let's start with you. How did you end up becoming a podcast host and content creator?
Well, first of all, thank you for having me. It's great to be here at Supplies event. I studied economics in college, and I started at a financial media company where I started as a producer, and then I interviewed the guests, and it was long-form financial content, which is what I've always done. And then I left that firm to start Forward Guidance for a company called Blockworks. So I did that for nearly 3 years. And so, yeah, pretty much out of college, I've been interviewing investors in a long-form content, in a long-form way.
And then, if I may, how did you decide now to break up from that and start your own thing?
Well, I wanted to really bet on myself and just continue to produce long-form content, as well as with my co-founder, who we're big believers in each other, and also try and bring that to the hedge fund world and basically help hedge funds improve their communications with potential investors. But yeah, I was not an owner in the previous podcast.
Gotcha. Kyla?
Yeah, so my path was a little bit untraditional, I think. I started off in college selling cars, and that's when I knew that I really cared about economics education, because the people that I was selling cars to sometimes didn't know what an interest rate was. And so for me, that was really formative. And during that time, I was studying economics and finance and data analytics, and I graduated and moved out to Los Angeles to work for a capital group on the buy side, where I did equity portfolio management, fixed income research. And then the pandemic hit, and I was like, what's happening? And so I decided to, again, focus on economics education and joined this company called On Deck and built out their investment education arm. And then I started making short-form videos on TikTok about GameStop. And so everything has kind of spiraled since then. It's been really cool, but the whole goal is economics education. I think it's super important that people know what they're investing in, the system that they're partaking in, and I try to give them all that information as digestible as possible.
And to your point, I mean, we all talk to each other all the time, so we know what we know, but most people don't know what we know. I mean, I encounter that all the time as a financial journalist, just talking to friends, and I sort of have this assumption of a base level of knowledge that a lot of people actually don't have, which is sort of incredible here. So talk to me, both of you, a little bit about who you see as your audiences. Who are you talking to when you're putting out this content? Kyla, let's start with you.
Yeah, so the apps give you quite a bit of data on the audience, which is quite useful. But the people that I primarily make content for are younger people, so between 20 and 40 years old. They usually work in tech or marketing. They're kind of outside of finance, but they're quite interested in learning how to invest and learning like how to buy a house, learning what interest rates are. And so that's the audience that I try to make videos for and write articles for, and who the book is for, is these people who want to know how to invest but don't know the first step that they should take.
And Jack?
And I have lots of good data on who my audience is in terms of demographic data, but it's not like they tell you what they're thinking or how much, so you kind of have to guess. I'd say my audience skews a lot older than Kyla's, probably in the 30 to 60 age range. And what was I going to say?
Do you think your audience is more, because the formats are different. For people who are not familiar with their content, Kyla makes videos. She is the video, and she explains things. She uses a whiteboard a lot. Jack is interviewing people about economic and financial concepts, right? So that's the main difference between them. Do you see your audience then as sort of having that base level of knowledge? Are they, in some cases, professionals in finance, or are they folks who want to learn more?
I would say it's both. It's a lot of professional investors. It's a lot of people who either are sophisticated financially or think of themselves as sophisticated financially. So I would say it's people who are interested in hardcore finance. And by the way, so just to kind of not to bury the lead, I think like one question is like, is traditional financial media going away? It could be a potential question. I think Yahoo Finance, Bloomberg, CNBC have like mastered the art of middle form content, like 3-minute to 10-minute segments. I think my content is longer form, and Kyla's done some great long form content as well, but she has gone to shorter form. So I think it's just things are growing rather than one eating each other's lunch.
Well, but to your point, I mean, it's not just about the length of the content, it's about what the content is, right? So let's talk about that a little bit. What do you think, what niche are you filling, what need are you filling, besides just sort of the length of the content that traditional media, what is not being spoken to, who is not being spoken to by traditional media that you guys think you're speaking to?
I think when you have longer form content, you can go a lot more in depth and attempt to try and explain what's really going on. As an example, when Silicon Valley Bank failed, you could try and do a 3 to 5 minute segment about it, but it's kind of complicated. So I feel good about the interviews that I did on Forward Guidance, some of which were like Sheila Bair, who ran the FDIC, about just the interest rate risks within the banking system, as well as the risks of bank runs. So you can try and get a little bit more in depth. And again, people study this 24/7, and you're never going to fully understand it, but just try and get a little bit more in the weeds.
And what about you?
Yeah, I think the way that I've tried to position my content is I call it human-centric economic analysis. So I try to incorporate a lot of philosophy, a lot of poems, a lot of literature into economics and finance, because that isn't often something that obviously a traditional media outlet would do, but it's something that can really break down barriers for people that are intimidated by economics and finance, as seeing a poem that they like or seeing a passage from a book that they love. And so I think that's something that I try to do in my longer form Substack work, and I did throughout the book. And then for the short form videos, I really try to take the very dense finance language and make it as simple as possible through whiteboard drawings, through different visualizations, through just shaping the language so people can digest it a little bit easier, because finance and economics is an entirely different language. And so those are the two ways that I try to think about doing things differently than traditional media would do it.
I'm curious about engagement too. How much do you all hear from the people who are listening and watching and reading your content? How much does that also shape how you do your coverage?
Yeah, so I imagine most people use Twitter in here. Yes? No? Okay, that's less than I thought. But I use Twitter quite a bit, and you'll find that if you post on Twitter, the audience will engage with you whether you like it or not. And it can really help you though to like think about things that you might have missed, to think about things a little bit differently, and that's across all platforms. And so I oftentimes will post just a general idea to my audience and talk about like the longshoreman strike, or talk about dating apps, and they'll come back with like all these amazing ideas because everyone is pretty smart, and then that can shape how I end up talking about stuff in the future. So I actually kind of co-create with my audience because of the engagement that they allow.
I want to pick on something you said, because I think it's fascinating that you just said, because everyone is pretty smart. Like that, so I think that that is an important note, that you presume, if not a certain level of education among your audience, a certain level of intelligence among your audience. And so while you are explaining concepts to them and educating them, you're not talking down to them. And so I wonder if that's something that you have cultivated very specifically, or if that's just kind of how you communicate, right, for both of you, because you want to be able to cast a wide net, to be able to speak to a lot of people, but you have to sort of have that, tread that fine line.
Yeah, no, I mean, I guess that's like the influencer part of all of this, is you do try to have that relatability. I don't love that word, but it is useful for talking about like making content direct to audience versus doing it through like a marketing firm. So you do end up building trust. Like, I posted almost 600 short form videos. Like that's hours and hours of me talking. And if somebody chooses to do so, they can watch hours and hours of me talking. And so you do kind of build up a trust with the audience in that way. But I think everyone's pretty smart. Like if you're seeking out some sort of economics or finance content, it's usually because you want to grow a bit. And so I found that people are pretty thoughtful.
And Jack, what about your interactions with your audience?
I think that, and I think I'm like much less revolutionary than Kyla, so I'm in this way more similar to the traditional media, that the audience, they are very intelligent, but like all of us, they are psychological creatures, and their demand for bullish content will be highest at the top, and their demand for bearish content will be lowest at the bottom. So you have to give them some medicine, keep them entertained, but also give them medicine and tell them how the psychological priors of myself are wrong, how they could be wrong, and how the guests are wrong, and just basically give them a sense of how hard it is to predict economics and markets, and just because they have a hunch, probably their hunch is wrong, and just give them a sense of I don't want to say reverence, but like. If I'm, interviewing someone who is like the chief economist for the BIS, it's like, yeah, he probably has thought about things that you and I haven't thought about, and just maybe just I get the point about being relatable, but there's also advantages of being, having I think a due reverence for these topics.
The value of expertise.
Yes, exactly. Thank you. Yeah.
Right. And do people like that? I mean, obviously you had a lot of downloads of Forward Guidance, and you're churning out a lot of interviews now for monetary matters. So people, the audience speaks with the numbers. But what, are you hearing from them that there are particular types of guests that they really want to hear from and that they really value?
Yes. So I'd say the amount of requests for guests, it's just shockingly small number. Like there are people who are total A-listers in my audience's mind, and not a lot of people outside of my audience would even consider these people big names, but they are to me and my audience. And so it is very guest dependent, and then you kind of have to introduce the guest to the audience, and that's how they become better known. And it's about introducing the guest in the right way, and also asking the guest what they actually know, what they're like. I don't like it when someone who's a volatility specialist is asked about like what a macro question. So like don't ask, if you're talking to a geopolitical expert, don't ask them about the VIX. It's that kind of stuff.
That happens to be a pet peeve of mine as well.
Yeah.
So I share that with you. So how do you pick your guests then?
So it's both a combination of what interests me and what I think will interest the audience, a combination of what is hot at the time, so what is becoming hot, and what was hot, but doing a sort of a postmortem analysis. So I'd say a combination of all those three. Example, I'd say China right now is becoming quite hot in the asset markets, and the vibe and the perception of topics lags the actual prices. And so if there was a huge surge in electric vehicle stocks over the past month, you're not going to see it in the analyst notes and the financial programming until a little bit. So the chatter lags the price. The narrative lags the price always.
For people who aren't familiar, do you want to give some examples of some of your recent guests? And I'm also curious, as a member of not as traditional media, what's the willingness? Do you find it easy to book people who you really want to talk to?
I would say it is very easy. People like being on TV. I'm not on TV, but people like being interviewed, and it's people generally say yes. And I can't even imagine a well-respected, established platform, Yahoo Finance, CNBC, Bloomberg. I imagine they almost never get no.
We'll leave that conversation for another time.
Yeah. I mean, Warren Buffett makes say no, but he's been on. But
Right. And who are some of the people who you've recently had on that have really been fun conversations?
I had Farley on, who is a managing partner here at Simplify, talking about interest rate volatility, and that is definitely a topic of example where it is really complicated and you do have to break stuff down. I think when explaining advanced topics to my audience, if the guest can do it, it would be great, but they're generally going to be speaking at a higher level.
So you're like the translator.
Yes. And I'd say I break it down by telling. I think Kyla has a different way that works great of showing. You tell a story in your short form content, and so it's much more showing rather than telling, I'd say.
And I wanted to ask you too, Kyla, how you pick your topics, how you figure out what you're going to talk about.
I think it's a similar path that Jack takes. You are responding to the attention economy at the end of the day, and so the topics do have to be something like that. But what I've tried to do recently with some of my Substacks is take bigger ideas and tie them together. So I wrote about dating apps and the demographic crisis. I'm working on a piece about the longshoreman strike and AI. I'm writing about elder care and childcare. So I try to write about pertinent topics that I think impact people. And of course make videos about them as well. But yeah, you do respond to kind of what's in the news most of the time.
And you're also pretty well known, I would say, for coining vibe session. For those of you who don't know, maybe have heard that term. So tell people how that came about, and sort of then it seemed to be everywhere.
Yeah, indeed. Yeah, so vibe session is a disconnect between consumer sentiment and economic data. It's basically, economic data is okay, but everybody feels bad, and why? Why is that happening? And so I wrote this piece back in July of 2022. It turned into New York Times op-ed, and then a year later, everyone started talking about it. So there's a little bit of a lag, but and it's way beyond me at this point. Stephen Colbert did an episode on it as well. And so it's really just kind of looking at the economy through the lens of consumer sentiment. We talk a little bit about consumer sentiment with inflation expectations and how people are thinking about things, but oftentimes how people feel does sort of get ignored in a big way. And so that was kind of the goal with Vibe Session, is be people are feeling bad. They're probably feeling bad for a reason, and we should probably figure out why that's happening. The vibes are not the first. I'm not the first person to talk about vibes, obviously. George Soros had reflexivity, Keynes had animal spirits. It's not a new concept. It was just new packaging, and some people really liked that word, and some people really didn't. So, yeah.
And where do you think we are with the vibe session,
the vibe session
at this point?
Yeah, this is an interesting question, because right now politics, we're going into an election, is influencing sentiment a little bit more than the economy. So I'm not sure where we are in terms of the economic vibe session. Consumer sentiment has kind of ticked up, but also University of Michigan changed the way that they collect consumer sentiment information. They were calling everybody on the phone, and then they switched to web-based. And then all of a sudden, everybody's expecting inflation to be at 17% now that they're doing web-based surveys. And so, yeah, it's a little bit confusing data-wise. GDP is still relatively strong. We're seeing deterioration in the labor market. Inflation is going in the right direction, so the economic metrics are still relatively okay. Sentiment seems relatively okay. So I don't think we're in the vibe session in the way that we used to be, but of course it's now being driven a lot more by political forces and economic.
And Jack, what are you hearing from, if you can synthesize some of the conversations you've been having recently?
Well, I think it's a great term. I think the reason why, it's obvious why people like the term. I think a reason why people are have a very strong negative reaction against the term is because it makes them feel like their view that the economy is in a recession is wrong, and it just draws attention to the very large different dispersion between how people feel versus the actual economic data. And I think that's an example about how you have to entertain people and to some degree confirm their prior beliefs, but also challenge them and give them medicine. Like you have to say, it's understandable why you think that inflation's still at 3% and prices have gone up and you feel like people can't afford things. Interest rates have gone up, so housing is extremely expensive to buy housing. But also inflation, the rate of inflation has gone down. Like economists who say inflation has dropped like a stone, and I've said inflation has dropped like a stone many times on my program, and we're not wrong, it has, and that is a very good economic outcome. But you have to explain to people that inflation going down, they think that means prices going down, and they're wrong, and economists are right. We understand why that is, but you're wrong. So yeah, I do that in a gentle, respectful way, I think.
Well, and that's like a language barrier too, which is really difficult to overcome. Like, what is inflation? A lot of people don't know. And they think inflation going down means that prices should be going down, but that's deflation. And so there's like that issue too, where again, it's like economics is an entirely different language. And when people see media headlines where it's like inflation is going down, but their box of cereal is still $7, they're gonna be mad because they think that means that prices should be going down. And so it's like kind of a difficult thing to navigate. And I think there's real reasons why people are feeling bad, like housing is a nightmare, childcare is extraordinarily expensive, elder care is extraordinarily expensive. And then if you look at a chart of sentiment in media headlines, it's like trended quite negative. We were talking about, like no offense to Bloomberg, but they have this headline where they're like 100% chance of recession by year end. This was written in 2022, and like we did not have a recession in 2022, but if you read that headline, you're gonna be like, oh man, world's ending, but it never happened. And so I think that is gonna influence like that sentiment gap in a very big way.
Well, that's a good reminder too that like, we talk about, you see on Twitter, prices have doubled since whatever, which we know that they haven't. But then you point out a headline you're talking about, and obviously that was wrong too. The people who were supposed to know it all, sorry, maybe some of the people in this room, apologies if that's some of you who thought that the recession was coming and it didn't come. So that's an interesting thing to kind of explore in your work too, is that yes, of course we value expertise, the people who are steeped in this stuff, but they can be wrong just like everybody else can be wrong. And maybe some of the time people who don't know as much can be right, conversely. But so when you're doing this kind of education, because as you say, emotion is so powerful when it comes to your pocketbook and your investments and how you see that world, how do you sort of navigate that? And do you feel like the information that you're giving to people is helping close that gap rather than just making them in some cases kind of lash out against it or have a knee-jerk reaction against it?
One thing I definitely believe, but I think I could do a better job of imparting to my audience, is just how humbling it is, and how even if you are a fantastically intelligent economist, you're going to get things wrong. And it's not like chemistry where the best chemists, they write an equation and that equation is always right. It's the rules are constantly changing. Like E does not equals MC squared. For example, high interest rates, as interest rates were going up, they were supposed to drastically weaken the earnings, the valuations of very highly valued tech stocks such as NVIDIA, the Magnificent Seven. And they did in 2022, but the correlations changed and interest rates have been going up as high-tech firms have increased in valuations, and actually it's been the lower quality companies, the smaller caps in the Russell 2000, that, suddenly those are the ones that actually are under pressure from higher interest rates. So the narrative changes. The narrative is never wrong, but when it is the narrative, but it's probably going to be wrong in a year or 2 years, so there are no eternal laws in finance. And I think that is something that, I definitely should do a better job of imparting to my audience, because I think the audience, regardless of who is, whether they're watching CNBC or Kyla or Bloomberg or you, that there is a fundamental need, within every human heart for certainty, and this is the future. This is a forecaster. We interviewed this forecaster. He's been right 9 out of 9 times. Here's him for his 10th prediction, and that's great marketing and it's effective. But I think that I definitely should do a better job of saying, look, he could have gotten lucky those 9 times. So, the inverted yield curve is for maybe that example.
And Kyla, obviously emotion is a big part of what you talk about. I mean, with the vibe session and with some of the other stuff that you cover. So how do you sort of navigate that gap?
Well, I mean, first, I'm wrong a lot. I was wrong on page 6 of my book, and that sucked big time. I've been wrong in videos that I've made for Bloomberg and have had to redact things because I misinterpret research papers. I've been wrong in how I've cited various statistics. And so I just want to make sure that it's not the big media is wrong and we're I've been wrong a lot. And when stuff like that happens and sort of managing the emotional side of it, I'm really honest with the audience. I made them a sticker that they could get for free about the mistake I made on page 6, which is about exchange rate economics and the dollar strengthening and weakening. And so, I actually, can you ask your question in a different way? Because I don't think I quite understand what you're asking.
Well, I guess what I'm sort of getting at is whether people get angry if they're corrected. I don't mean you guys. I mean more the audience out there. In other words, if my perception is I go to the grocery store and I'm paying $15 a carton for eggs. I'm exaggerating, but and you're telling me the prices that the rate of inflation has gone down now? What are you talking about? So right. I just wonder what kind of engagement and feedback you get where people tell you that you're wrong, even though the facts are right, they feel it's wrong.
Well, it's interesting because economics is so personal, right? Everybody has a personal experience with inflation, with the labor market, with the housing market, and we talk about everything in terms of averages. And so I can be talking about something in terms of averages, and somebody can be like, that doesn't apply to me, and they're right. And they can be a little mad at me about that because I'm not talking to them. And they should understand that I can't make a video for every person on earth. But I think there's definitely a lot of frustration. Economics is co-opted by a lot of bad actors as well as finance. There's just a lot of doom and gloom people who want to lead people down a bad path. And that's mentality can be quite tough to get people out of. But at the end of the day, you just point them to data sources and tell them that they can look at the data and get back to you. That's kind of what I end up doing most of the time.
So you guys, it's hard to stand out in that financial influencing landscape. There are a lot, it's democratized, which is great, but then it's also hard. You guys are making a living doing this, which is pretty impressive. So how do you stand out when you have created this thing yourself? Jack?
I guess you do have to be effective at grabbing people's attention. That's step one. And then you have to be effective at keeping people's attention. And if you do one but not the other, it's not going to be nearly as effective as if you do both. That's a tough question. I think there's it's a very saturated space for, I would say, pretty sensationalist media. There's some guy on Twitter who is talking about how basically Vanguard and BlackRock control every single company, which if you look up the ownership, it is correct. But of course, as everyone in this audience knows, they own it on behalf of investors, and they are not the controller of the company. And that is just one of many financial myths. That in particular drives me crazy. But these people have 700,000 Twitter followers, so I think there is going to be a very high demand for that amount of content. It is a really tough question. I do think inherent in your previous question to Kyla was the question about cognitive biases, I think Kyla does a much better job than I do, to be honest, of just educating the audience about cognitive biases, and maybe going forward, I should do a better job of that. But you do have to, let people know. Oh, I was going to say, Kyla, when you said you can just show them the data, yes, but there's always going to be another piece of economic data. I think that is a piece, like there's thousands of economic pieces of data that can confirm any bias. So, in 2022, the hard data was looking good on a nominal basis. The surveys, the PMIs were looking horrible. Now the hard data is weakening, but there's data for everyone. No landing, soft landing, recession, inflationary boom. There's hundreds of economic data points to support every single view. So that's tough.
Well, and also like survey data is tough too because the response rate to surveys has basically collapsed. And so like JOLTS, for example, the job openings and labor turnover survey, it's not as effective as it used to be because people aren't responding to the economic survey. So there's all sorts of problems with data. Yeah, yeah. But that's kind of what I'm just like, take the data.
Yeah. So to go back to something you were saying though, that, I think the point you're making about the person who puts that out about Vanguard, BlackRock, like there's misinformation, disinformation. It's not unique to politics or current events or whatever. It can happen with finance also. And kind of what you were talking about, Kyla, that there, with everything there are doomers, right? And they're going to get the most attention. We know that in our algorithmic-driven social media society, that the more extreme you are, the more it funnels you, the system funnels you in that direction, which again makes it even more impressive that you two who don't do that have done as well as you have. So Kyla, I guess I'll come back to the question for you, which is like, how did you get so many followers, and how did you sort of break out of this very crowded field?
I pretended to be Jerome Powell. So that was, I think, kind of what got people looking at the videos in the first place, is I would do these skits about the FOMC meeting, which I don't think anybody else has done. If they have, I'd love to see it. But yeah, so I just had a lot of fun with the topics. We tend to take finance and economics so very seriously. And you really can have quite a bit of fun with it because it's like a little silly when you look at it. Like, okay, this guy comes out and people are like, "What color is this tie?" And so I that's kind of how I got my start. It was like doing various skits. I did skits on Archegos, skits on other things, and yeah. So I think that was kind of like the first part where people were like, "Huh, that's a little weird."
Yeah, and also like, I think your ages probably don't hurt when it comes to this stuff in terms of being digital natives or whatever you want to call it as well. Kyla, I'm curious about the dating topic that you did, because that one also got, I feel like, a lot of attention. So why did you choose to talk about that? What did you say for people who are not familiar?
Yeah.
And that one seemed to blow up a little bit as well.
Yeah. So the underlying theory is that we're headed towards somewhat of a demographic crisis. We have an aging population, and the fertility rate is below the replacement rate, so we're just not having enough babies to kind of keep up with the aging population. Of course, that's going to put pressure on Social Security, on Medicare, Medicaid. And basically, I was like, the dating apps should be better. They should be better for people because they are kind of one of our main solutions to probably solving the demographic crisis, is if we can get people to date. And the main way that people meet right now is on dating apps, statistically speaking. And so it was kind of this article, analyzing the beginning of dating apps, starting with like Match.com, Tinder, Bumble, Hinge, what has happened to those stocks. They've been in the tank except for Grindr, and kind of like how we can think about dating and dating apps in light of a much larger problem, which is, how do we help people have children if they choose to do so?
And that one kind of sits at the intersection of it being fun to talk about. People like to talk about that, and also sort of educational. So to come back to the bigger media system, kind of where do we go from here in terms of media like yours, traditional financial media, how people are going to get their information. How do you think that's going to evolve? Jack, I know you've thought a little bit about this issue.
I'd say I'm much more constructive, and of course constructive is just a euphemism for bullish. I'm much more constructive on legacy, and so CNBC, Bloomberg, Yahoo Finance.
Would that also include Wall Street Journal, Financial Times,
yes,
sort of that kind of
it
traditional
would.
media too?
Then I am on the legacy media outside of the financial world. I think that a trend that is occurring in all media is people trusting individuals rather than institutions. I think some of that has to do with other things, but some of that I think is just technology, and people can produce their own content by themselves. They no longer need to work at a newspaper that has enough capital to own a paper mill, and it is quite cheap to produce content, and that has occurred in both. I think that will continue. And to put it short, I don't think the genie is going out of the bottle, but I think there definitely is still a place for the trusted brands in financial media. I just think it will become a little bit more decentralized and spread out, as it has drastically in other forms of media.
Kyla, what do you think?
Yeah, I would agree with Jack. There's capital constraints to doing this by yourself, and for media organizations, they do tend to have a little bit more money, and so I think we're kind of seeing this. It'll be interesting with AI and sort of how AI influences how people consume content. If we all start consuming AI-generated videos, I'm out of a job, and I don't know what'll happen with that. But I do think legacy media has the trust of institutions, and that's very, very useful. The trust of individuals is also very, very useful. So I'm kind of saying the reverse of what you're saying, where it's helpful that the institutions trust legacy, even though individuals will trust individuals. Does that make sense?
Yeah.
Yeah.
I'm curious in the audience right now, how many of you have ever gotten a call from a client who said, I saw this online or that online, and that thing, you had to then kind of disabuse them of whatever they were talking about? Show of hands, anybody get those calls? So I think that's an interesting point too, that there is the issue of credibility, right? Yeah. When you talk about individuals who get these followings and people really put a lot of stock in what they say, of course the downside and the danger of this, and this can happen at traditional media as well, but maybe there's a higher risk, or you tell me what you think. Is there a higher risk with an individual that they can potentially do more damage?
I think, and I'll say two notable examples within legacy financial media, there are things that are just not true that are frequently said and do kind of manipulate the audience's example. I do not think that independent media, such as Kyla and myself, and not just talking about us, but the entire thing is by any means exempt, and in some cases it can be definitely worse. But for example, when egg prices were at their peak, there was a New York Times article in the business section about how the prices of eggs was so drastic and just draining everyone's money from their wallets that people were turning to creating their own chicken farms, and they had their own hens. And I think that is an example of the media blowing stuff out of proportion, and that definitely happens outside of the legacy media. I think it's a responsibility to be accurate, both in terms of what has happened, but in terms of predictions, and to ground things in a proper sense of, just a set of how hard things are to predict. The other thing is on, the financial networks. If some things are attributed, movements in asset prices are attributed to events which are not correlated, and so the words are as and amid are frequently used. So a piece of the jobs report
I'm familiar with that trick.
The jobs report comes out. Oftentimes the jobs report is very market moving. People referenced August 5th or 6th sell off, the August 2nd or 1st non-farm payrolls, yen unwind, carry trade. But oftentimes the economic data point, most of the time, is a nothing burger, and you say stocks jitters as non-farm payroll comes in below expectations. And I think that it's the duty of all journalists and content creators to try and fight that. You can't fight it entirely, but just try and be a little bit more accurate. And I'll also say that I think that the way things are reported is important as well.
Yeah. My own aside about that would be, it's a lot tougher in print versus spoken. In other words, the amid and the as is usually in print.
Yes.
Whereas I have the luxury, because I'm talking, to say, well, this happened, and stop, the markets are doing this. It might be because of that, but it might not. We don't know conclusively. It's tougher to do that to thread that needle, I think, in a print story. But yes, that is definitely a thing that happens. What do you think, Kyla, in terms of that? Now I've forgotten the question that started that in the first place.
Whether there's a greater risk of
yes.
misinformation, disinformation.
Yes.
In traditional media?
Yes, in traditional or in sort of new media influencers.
Oh, well, I mean, I think influencers are playing to the algorithm, like what Jack was talking about with that person who makes videos talking about BlackRock and has a clear misunderstanding of pretty much everything.
Or
what?
Or do they? I mean, maybe they don't have a misunderstanding at all. Maybe they're perfectly
cynical.
Yeah,
right.
No, it's a great, that's true. But yeah, you're always playing into the hands of the attention economy, I think, and TikTok is massively rewards that. You know, our eyes are the most expensive things that we own. And if you can kind of capture that on the individual platforms, I think it can be a great payoff. So I think both sides do it. It's just, it can be very, very noticeable on social media. Yeah. So
I guess then a different way of asking this question would be, where do you, and you kind of addressed some of this, Jack, where do you think traditional financial media, and this is a little bit of a selfish question, I admit, where do you think traditional financial media falls down the most? Where do you think it sort of fails the most in the biggest way or the most frequently that you think that new media influencers kind of have corrected for?
Let's see. I would probably say not the big three, Bloomberg, CNBC, Yahoo Finance, but probably media companies that raised a lot of money over the past 5 to 10 years and are not profitable, and people don't really like their content, and they've kind of just been forced upon views. And people aren't watching because they like it. They're watching it because they're not really locked into that type of content. That I'd say is probably at the greatest risk. Yeah, I think there was a lot of venture capital funded media companies over the past 5 to 10 years. So that's probably my answer.
Mm-hmm. Yeah, no, I would agree with that too. Yeah, I think that a lot of bloated companies exist and they can say things that aren't true a lot of the time.
So basically, like inaccuracy or grasping for views. I mean, that can happen with traditional media, just like it can happen with the TikTok creators. They're sort of tempted by that same extremist or doomerist kind of headlines. Is that what you?
Doomerism is only one type of clickbait that they are reliant upon. I think they're reliant upon an algorithm that is easily copyable. They think they have a moat when they don't. And a lot of people are there for specific people, and if they leave, they're in trouble.
So we only have a couple minutes left. So in the last couple minutes, 5, 10 years from now, how much of people's financial news do you think, and content and commentary, do you think they'll be getting from influencers, podcasts, content like yours, versus the more, how much do you think it will have changed 5, 10 years from now?
I think it will have changed a lot, but it will have gone slowly. I think a lot is already consumed. Like I think probably not in media, but the marginal analysis of companies is coming from independent research shops, not the big banks. And I think that, it kind of already is, but I think that it's going to happen slowly, and nothing will be drastic.
Kyla, what do you think?
Yeah, I think that coffee spilled back there, but sorry for calling you out. But yeah, I think that you already see Joe Rogan being the #1 podcast And so I think that that's just going to carry over into pretty much all industries. People do like to have like that one person who they kind of hang on to the words of. Whether those people will be bought by big media companies, I'm not sure. We'll see. Yeah.
Or paid by in the case of Joe Rogan.
In the case of Joe Rogan.
Thank you guys so much. Kyla, Scanlon, Jack Farley, really appreciate it.